Last week, we talked about what whole life is and a bit of the history on it. Today, we're going to talk about paid-up additions, the critical building block in high cash value life insurance when we do these optimized designs to get high cash value early and a well-performing high cash value in the long run. Paid-up additions is where it's at. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Vaquero with NetWealth Finance.
Appreciate you guys joining us again this week. Paid-up additions. This is the key to success in high cash value designs. At the base, what's a paid-up addition, Carlo?
So in long form, we could say paid up additional insurance or paid up additional units of insurance. And what that means in short is you have fully paid off an amount of insurance. And so at its core, when you buy paid up additions, you own those for the rest of your life. And that becomes cash value also in your policy that will eventually will grow over time as well. So paid up additions are really at the core of what we're doing when it comes to whole life.
Yeah, so a paid-up addition is a one-time payment that buys a death benefit right there. And it's like buying a little miniature whole life policy with one payment. No more ongoing payments. What does that paid-up addition get you every single year after that?
So you get the same guaranteed growth that is attached to your life insurance, your base whole life. And on top of that, there is also the surplus dividend that can be applied to those paid up additions. That's why it really comes down to when you can do mostly paid up additions in your overall whole life policy, cash value growth is going to just increase with that.
Yeah, if you want to visualize this is going to kind of blow your mind, but it has to do with the compounding effect too. If you picture like a tree growing, and a dividend is a branch that grows off that tree. So the tree is your initial base whole life policy. Your first dividend payment is a branch that comes off of that tree. And that dividend payment is buying paid up additions. And those paid up additions are branches that are coming off of that dividend. And every year, every single branch that was a dividend from a prior year that became a paid up addition is going to create its own dividend and a new branch. And so you just get this tree that's constantly expanding in every direction. Not just one, but every single one of those, every single year are going to continue to sprout new paid up life insurance policies. Because one of the options when you get paid a dividend is that you can choose to have it buy a paid up addition. You don't have to do that. You can just take it in cash. But the key to these cash growing policies is to get that tax deferred growth by turning it into a paid up addition instead.
That's a really good analogy. I really like that sort of branching compounding effect that happens with these paid up additions. And in a lot of ways, I like to think about it very similar to a normal dividend growth strategy. It's really the same kind of concept. If you have an equity portfolio, maybe some ETF where you have a dividend growth strategy, there might be some growth in that position, but it also pays a dividend off that buys more units. And that's kind of the same thing when it comes to paid up additions. Paid up additions can pay that dividend that also creates more paid up additions that pay more dividends. So I think it's a really good way to put it.
Yeah. And now let's shift over to the high cash value designs that we like to do. Paid up additions play a massive part in the specially designed policies that generate cash value early on. When we do a paid up addition, 90%, sometimes more, turns into cash value right when you make that payment. And that cash value is liquid. You're able to access that cash value if you need to go do other investments or really anything else. It's just like adding to your line of credit every time you make a paid up addition payment.
Yes, and that's why when we look to design these optimal policies, we are targeting the majority of the payments being paid up additions. Ideally, not every situation will warrant that, But in most cases, when we do these optimal designs, we want a high percentage to be going to those paid up additions, 80, 90% oftentimes.
Yeah, and one of the big reasons that we try to do that is because that type of a design means less commissions get paid out to the agents. Whole life, the bulk of the commissions is determined on the base of a policy. What is that base whole life portion? And all of the paid up additions pay a very, very small commission to an agent. That savings means more cash in your policy that's available for you to use right away.
So there's some people in this space that will make arguments for blends that are not as heavy as we like to use. We like to use the optimal design, which is going to tend to be the maximum amount of paid up additions that we can allow for a given policy. There are some people who might promote, well, don't go with that fully optimized. Maybe you want to go 50-50 of base and paid up additions, because the dividend rate that is paid on that base might be higher for some carriers. It's a claim, and in some cases, there's some truth to that, but it never really overcomes. When you design it that way, it never really overcomes the fact that you are starting with lower cash value being realized in that base policy in those early years. So it doesn't overcome the math difference that is made up versus the optimized design.
Great points. And this might be kind of getting into the weeds to do on a podcast where you can't really see this. But with the optimized designs that we advocate for, you start out with so much more cash value. Let's say 80% of your initial payment turns into cash value in year one. And you're immediately earning the base, guaranteed growth rate, and the excess dividends on all 80% of that. And if you had a policy that didn't have paid up additions, it was all base, you're not getting any growth in that first year. You're not getting any dividends. It might take you a couple years before you start to grow a little bit of cash value in that policy. And it's that little bit of cash value that's going to be starting to earn paid up additions. That's going to start buying more new paid up additions. And different insurance companies will credit a paid up addition differently than a base whole life, which does lead to some people claiming that's why you shouldn't do a paid up addition heavy policy. But as you pointed out, that paid up addition heavy policy starts off with much higher cash value, and it continues having higher cash value and higher death benefit for almost the entire life of the policy, if not the entire life of the policy. The other designs just never catch up in cash value or death benefit. So when you get to be 30 years older than you are when you start the policy, what do you care if the insurance company is giving you a little bit more money with a bad design policy because you got the bad design if the overall cash value is way lower than an optimized design? I would venture to say that you don't really care about that in that situation. The money in the hand is what matters. What do I have access to? Do I have access to a few $100,000 more because I got an optimized design and I paid lower commissions? Sign me up.
Yes, and I actually have some videos on this concept where I walk through these comparisons of these different designs on my channel. And I think James also has these. There's a number of creators out there that have these comparisons. And really, if you, like James said, it's hard to actually talk through in just an audio format or without visual elements. So I would recommend checking out some of those videos if you really want to see the difference when these designs are optimized versus suboptimal designs.
That sounds like a good call to action for our listeners this week. Is there anything else that we haven't covered as far as paid up additions go that you want to mention before we finalize the call to action?
No, I think we've covered it pretty well on this episode.
All right. Well, my call to action would basically be similar to yours. Go check out our videos on either of our channels because we show you what it looks like when you get an optimized design. You're going to have to look for the whole life specific videos because we got all kinds. But in our whole life videos, you're going to see what paid up additions look like, how we design for those, and what makes those policies work really good for high cash value. Next week, we're going to do all about the dividends. And this is an opportune time because a lot of insurance companies announce their new dividend rates for the next year this month. Some of them have already announced in November, but certainly by the end of December, you're going to have all of the new announcements. When you buy a policy, you actually know what the dividend rate is going to be the following year. So we'll go into everything you need to know about the dividends next week. As for this week, I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Becerra. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. We'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.